going to present today is about advertising. All right, you may be wondering, why am I dealing with this topic? Because I've been doing with R&D and intellectual property for long, well, in fact, think about what because I've been doing patent R&D, but then I started touch on other intangible assets like a trademark, brand names, right? And how do you establish a brand name? Of course, you need to spend on marketing and advertising, and that gave me intrigued by the advertising expenditures. Yeah, I've been. Anyway, you are going to see, right? The more you learn about accounting, maybe the. Oh, okay. I should stop here. All right. This paper was Ofir and David Reeb from National University of Singapore, and Hsiao-Hui Lee and Hunghua Pan from National Chenji and National Tsing Hua. Okay. All right. And we all know that when we learn accounting 101, right? The under the SG&A sales expenses, we have the so-called marketing. Advertising expenses, just like R&D, which is very important item to be reported, which is what we learned, and we believe it's true. However, guess what? If you look at Apple, Apple actually didn't bother reporting advertising expenditures. If you read its footnote, say, our marketing and the advertising expenditure have been included in our SG&A, and that's it. All right. So basically, Apple pull every related expenses under SG&A without letting you know what exactly is going on there. And we see commercials by Apple all day long, right? So apparently they spend a lot, but they just don't tell us what they are doing. And then let me give you another example, like Walt Disney, right? Disneyland. Disney has been, should I say honest, or Disney has been disclosing their advertising expenditures, right? 92, 93, 94, right? Apparently the number is super high, like, over 1 billion, which is larger than 1% of sales, which actually should be reported. But guess what? Disney stopped reporting advertising since 1995. So if you look at its income statement, actually, you won't see advertising expenditure starting 1995. And of course, we are not saying that the advertising is gone. It's not expensive. No. It's still expensive, but just hidden or buried in the SG&A without letting people know much about. So I think this is very relevant to the redaction paper Mustafa just presented, right? Managers, they actually have incentive to hide information for either good thing or bad thing. We are going to discuss in the next slide. Okay, but now coming to the ground truth, like, if a firm like Disney or Apple are not reporting their advertising, then how do we know, right? Maybe they suddenly cut all the advertising, right? And luckily we have what? We have a Kantar Group. Kantar Group is a professional marketing consulting firm, which has expertise in collecting, all kind of marketing expenses data around the world, including like a print, broadcast, even online medias these days. So we can, we have their data about observed advertising expenditure, which is in contrast to the reported, reported advertising is what we know the XAD term in CompuStat. So we have two terms. One is observed by Kantar, the other reported by CompuStat. And so we can actually classify all public firms into three groups. The first group is we call it confidential advertiser. What it means is those firms, they don't report advertising, all right? However, they observe advertising based on Kantar Group, the data we purchased, okay, is larger than 5% of our pre-tax income. Of course, you can say that 5% pre-tax income, how do we come up with this filter? Oh, we follow accounting literature, which actually is a threshold which should be used according to SEC statement in principle. But they chose not to, so we call this group of firms as confidential advertiser. And the second group, they don't report. However, they observe advertising is also below a threshold. So we call them true zero firms because they are, maybe their advertising is negligible, right? The third group, they report advertising, and then we treated them as a reporting firms. They have been reporting their advertising expenditure. So in our sample, we have a total of 3 groups of firms. Yeah, and now you may wonder, like, how does the Kantar data look like? Well, in our sample, the average firm with a reported advertising based on Kantar data actually spend like 26 million. So this is not a small number. And we also have a breakdown of our print and publishing by online or broadcast categories. All right, and so now let me give you an example. How do we identify a confidential advertiser using Disney as an example? Disney doesn't report advertising in starting 95. So, but based on Kantar Group, we know they spend 631 million, which is, of course, the number is still smaller than the advertising reported last year, but at least it's a significant amount, which accounts to like larger than 1% of their revenue or larger than 5% of their pre-tax income, actually as high as 30% of pre-tax income. So indeed, Disney spent a lot, but Disney didn't report, but Kantar helped us to catch that. So we treated Disney as a confidential advertiser since 1995. All right, so now back to our hypothesis or research question, right? What do we really try to ask? I mean, what is the motivation for firms or managers not to disclose their advertising? Well, they usually resort to the so-called proprietary cost argument. They say if we disclose too much, right, then we will let our competitors learn, imitate. So we are going to lose our edge, our advantages, which is a common argument the manager will use in hiding their information. However, we want to bring out another side, with the darker side, agency costs, right? Maybe managers, they intentionally disclose advertising expenses or even R&D or even other things, right? Just because for their own benefits. And in this paper, we try to see which side stories are closer to truth, or maybe both sides are right. It's just a mixture of both. All right, so let me quickly overview our results. We first found that the confidential advertisers' market valuation, i.e. their stock price valuation, is actually lower than other firms, which is actually against the manager's argument of proprietary costs, right? If managers say, I'm doing this for the shareholders' benefit, but turns out their firms are discounted by stock markets, which doesn't support their proprietary cost argument. And then we found that, how about stock analysts, right? Stock analysts, they are professional. However, we found stock analysts, actually their forecasts tend to have higher dispersion and actually lower estimates of firms' earnings per share, EPS, which suggests that even stock analysts, they don't know what's going on with the firms. So they couldn't get correct information because of their higher dispersion. And we also collect the conference call data, and we found that indeed analysts ask more questions about marketing or advertising related information in conference call. However, guess what? For confidential advertisers. But guess what? Managers don't answer, or at least don't answer in a way that we can record. So we found that those managers, they actually don't report more soft information. All right, so it suggests that managers, they actually may intentionally hide some information. Of course, this could be neutral. Maybe at this stage, managers are still protecting shareholders. They just don't want to leak too much information to their peers. All right, but how about the next two tests? Then we found that when firms have a new CEOs, actually they are systematically more likely to choose not to report or stop reporting their advertising. Okay, so which start to give us more supporting evidence to the agency costs, right? Because for managers, if they discover too much information, especially about expenses, then they may be criticized for not efficiently investing in marketing in the future. So they choose to cut their disclosure, so they are less likely to be criticized in the future. And lastly, we found insider trading profits increased with the firms when firms switch from reporting to non-reporting, from reporting to confidential advertiser, which further supports agency costs. What's going on, driving this kind of hidden advertising. Yeah. Let me quickly talk about sample. I'm not going to talk about hypothesis or something due to time limit. In fact, let me see how. Okay, I think I'm doing well. All right, so we collect, Kantar data group from 1995, which is the first year available time in there, to 2019. We spent a fortune to try to get the data. Then combined with CompuStat. And so we total have over 6,000 of firms at the list with the Kantar information. And then we found that the firms without reporting advertising in CompuStat make up like a half, which is surprising, right? Like half of firms, they don't bother reporting advertising. And for another half, and we found that 14% of firms are actually confidential advertiser. Of course, then you may say, oh, so Paul, then this is a small portion, right? Like a 1 out of 7. But no. These choose not to report are big advertiser, okay? Basically, the more you spend, the less likely you want to disclose. I'm going to show you some statistics. In fact, since we are here, so let me show you the aggregate. When we aggregate all unreported advertising, we are talking about $5 to $10 billion per year. All right, this is not a small amount from our aggregate. But now, what if we break down firms by their observed advertising by 5% all the way into 20 groups? And guess what? If we look at the rightmost histogram of this chart, you see actually the top 5% of hidden of confidential advertisers are actually spending almost 500 million per year on advertising, 500 million per year. All right, but they just don't report. Yeah. Okay. All right. So you may be wondering, like, how correlated is Kantar observed advertising with reported CompuStat? Well, the correlation is as high as 70%. Of course, in general, Kantar's amount will be like a 1/3 to a half of a CompuStat if a firm reports. Well, because in CompuStat, the advertising expenditure can include a lot of other things like human capital things. But Kantar only based on observed, expenses like how much you pay to channels. Yeah, but overall, we have a high confidence about the Kantar data quality. I think. Okay, I think I will skip this. Oops. Somehow, okay. Somehow it freezes. All right. So now let's move on to our first research question. Does shareholder benefit if such a non-disclosure is really about proprietary cost? Well, as you can see here, once a firm is a confidential advertiser, actually it's a price to book equity ratio is lower, its Tobin's Q is also lower, contrary a bunch of things. So which actually disproves the proprietary cost argument, i.e. Shareholders don't benefit. Of course, some may say, well, manager may argue, well, but stock analysts can help shareholder to understand it, right? But unfortunately, this is not the case. In this table, we report the forecast dispersion of analyst EPS forecast. The larger means that the analysts don't know how to estimate. And we see confidential advertising is associated with higher forecast dispersion. On the other hand, how about the forecast error? We found the forecast error is lower for confidential advertisers, suggesting that when analysts are forecasting confidential advertiser EPS, analysts have to adjust the EPS lower, right? Because they don't know what's going on. They don't know what's going on. That's the only explanation we can come up with. Okay, I think I will. Yeah, and of course, if the underestimation is higher, then actually we found the price discount is also deeper, which further supports our argument. I combine two tests together. Okay, so now we move on to our second stage, which gives us more like how to call it micro evidence, right? How do we know it's really information going on, right? How do we know it's like a firm's managers intentionally hide the information? Well, we use earnings code, right? And because the Capital IQ transcript give the details sentence by sentence, word by word record of conference calls. So we search marketing related words like marketing, brands, advertising, branding, and promotion. And we collect over 14,000 earnings calls. Yeah. And what we found is that analysts are more likely to ask. Okay, if you can see this. Oops. Anyway, I can move my mouse around. You see the confident advertiser, analysts will have 50% of chance in asking marketing related questions. But for reporting firms, the analysts will have only 45% of chance. The difference is significant. Or for true zero, of course, the ratio is much lower. And how about executive answers? Guess what? Executive answers are like 70% or 67%, but the difference is insignificant. Such that, managers don't answer more questions about marketing. And now we move on to the agency costs, right? Why would the managers, what's the benefit for them? Well, because you can say that earnings per share are unaffected, right? Because SG&A costs are still there. Yes, but if a manager discloses too much information, then actually they may be blamed for inefficient spending on maybe one item or R&D or maybe advertising. So if they pull everything together to SG&A, then it's less likely for them to be criticized for every investment. And it's more likely for new CEO because they are shorter in tenure. So they are more concerned about their job security. Because guess what? Over 60% of CEOs couldn't survive 2 years. I.e., if there are 10 CEOs, 6 of them couldn't survive 2 years of tenure. All right, suggesting that it is a high-risk job, so they need to protect themselves. And indeed, we found that for CEOs with shorter tenure, they are more likely to hide advertising information. All right. So now come to identification, right? We always try to at least come up with some also interpretation of our result. Luckily, we have a regulatory change in accounting rule. Let's call Financial Reporting Release 44, FRR 44. Before FRR 44, actually firms by default have to report their advertising as long as it exceeds 1% of sales. However, after the regulatory change, firms now can say, oh, although this number is super high, but it's not material. Okay, as long as my auditors say yes, then I'm totally okay for not disclosing the amount in my financial statement. So i.e. firms before FR 44, they have to disclose, but after FR 44, they have no choice, they have to disclose. And yeah, so we do a DID. So we found that if you are confidential advertiser and after if you are switcher after 1995, indeed the annual forecast dispersion increases, forecast error is more discounted, and well, new CEOs tend to hide more, tend to be switcher more often. And oh, this is the last one. Is a net purchase tend to be higher, suggesting insider trading profits, as we are showing here. Oops, this is firm value. Oh, I forgot to put the insider trading profits. All right, so this is my last slide. I would like to talk about implications. What can we learn from this study? First, although the SEC noted in the FRR 44 saying that, oh, several analysts saying that we should let managers decide what to disclose, what to not to disclose. so to protect shareholders or protect firm value. But our empirical evidence suggests the opposite. Suggests that it will increase investor uncertainty. Yes. And second, the manager's argument about proprietary costs is actually an excuse. And the last thing is that we are very glad to see the current trend. That is, in accounting, the FASB began the project about disaggregation income statement expenses, i.e., the FASB is encouraging the policy to providing disclosing more details of income statement items, which our result provide frontier evidence that such a separation should benefit investors, should mitigate agency costs on manager's side. Okay, so that would be our paper. Thank you very much.